to attending today's webinar on personal financial planning, especially for the year end. And we have some great panelists with us today. We have Max Wellinger, Director of our Rehmann Capital Management Group, Tony Licavoli, Director of Tax Consulting, and Kathy Shoemaker, Director of Estate Gift and Trust, and myself, where I lead our private client advisory practice. And one thing that's really kind of unique about Rehmann and what we're going to talk about today through our panelists is our personal planning experience that's delivered through our private client advisory service model. And we define private client advisory as really an integrated team of specialists to help guide our clients through their life events to provide clarity, confidence, and peace of mind. We all experience these life events. You might be preparing for retirement, might be preparing your estate plan, working on tax saving strategies, tax complex issues, and it's all delivered through this integrated team. It's really an umbrella of solutions: advisory and tax returns, personal and business, tax strategies, tax saving strategies, Rehmann Wealth Management, complex financial planning, cash flow analysis, investment strategies, estate gift and trust, preparing your estate plan. How can we save estate taxes? As well through our family office for those high net worth individuals and their families. And last, Rehmann Trust. We have the capacity as a corporate trustee to work on existing trusts and also as a successor trustee on future generations. And the idea behind private client advisory in this integrated team is that we're collaborating together at the very beginning. So as you go through the process to become a Rehmann client or are a Rehmann client, you might have one initial need, and that might be tax planning. But you'll be surrounded with this team from the beginning, either from wealth or estates or other areas within Rehmann, so we can provide that proactive service and really help our clients with their short, medium, and long-term goals. Really help our clients, think of things maybe they haven't thought of, to be proactive instead of reactive. So I'm going to turn over to Max Wellinger to talk about the markets. He's the director of our Rehmann Capital Management Group that manages our investment portfolios. Take it away, Max.
Thanks, Tom. So I'd say, as 2024 comes to an end here, Sarah, if you'll advance one slide, shaping up to a really strong year for the market. Coming into this year, there was a lot of concern around a potential recession, but that really ultimately hasn't occurred. Not only that, economic growth has been very resilient, and that's allowed corporate profits to be really strong. And beyond that, we've seen inflation across the globe continue to slow, which has in turn allowed central banks to start to cut rates. And we've seen the Fed do that along with many others across the world. And really those two factors, I'd say, have allowed the stock market to keep rallying throughout much of the year. Then in November, we reached new highs as investors cheered the prospect of lower corporate taxes and less regulation under a new White House. So here, as you can see on the screen, through the end of the last week, the S&P 500 is up north of 25% this year, once again led by a lot of those mega cap technology stocks tied to the AI theme. You've heard them maybe called the Magnificent Seven. At the same time, small cap stocks had a good year as well, up around 22%, and international was up around 7% as well. So good year for the stock market. Bonds had some volatility, but ultimately did still post a positive return as well. So as we look ahead to 2025 on the next slide here, I'd say we do still have a positive outlook, but we recognize that it could be tough to repeat the same level of performance that we saw this year, especially considering that there has been a lot that changed over the last 12 months. But as we look ahead to next year, there's kind of three big things that we've been talking with clients about, or that we think investors should keep in mind. The first is the importance of rebalancing portfolios. The second is that long-term yields could remain elevated in the near term. And the third is that volatility could pick up. We are working on a written piece on all of these topics, but today I'll give you a little bit of a sneak peek into that here. Starting with the first theme. So really, yeah, perfect right here. After such a strong year for stocks, we think it's really important, again, for investors to revisit their allocations and consider rebalancing. And by that, I mean bringing each asset class back to its target by selling some of what's done well in the portfolio and reallocating those proceeds to what might have lagged. Not only a very important strategy for managing risk, but it can be a really good tool for being very disciplined and buying low and selling high, with the important caveat being to be mindful of taxes. But within equities, we think it's especially important today, just given how strong large cap stocks performance has been, led by those kind of high-flying Magnificent Seven names. Often probably makes up a big portion of a lot of clients' portfolios today, but they also trade at fairly lofty valuations, which could limit some upside from here. But at the same time, much of the rest of the market, whether it be small caps, mid caps, or international stocks, which have lagged a little bit, do trade at much more reasonable valuations and might be better positioned for upside down the road. Similarly, on the next slide, bonds have gone through a rough couple of years here, but we do think that asset class has undergone something of a generational reset, setting up for brighter days ahead. For one, bond yields are currently much higher than they were for much of the last decade, and recognizing that yields really are the main driver of return for bonds, that means the forward-looking return expectations have gone up quite a bit. In addition to getting a nice attractive income levels, high quality bonds also offer potential for capital appreciation in the event of an economic slowdown. So that makes them a good diversifier to stocks as well. The second theme is that despite the Fed currently cutting short-term interest rates, there are some factors that could prevent longer-term yields from falling by the same magnitude. That's also known as a yield curve steepening. Keeping in mind that short-term rates are controlled by the Fed, but longer-term interest rates are really determined by the market. So as we've seen this year, the Fed's been starting to cut interest rates and short-term yields have fallen. You can see that in the rates you get on a savings account, a money market, or floating rate debt. But at the same time, longer dated bonds, think of a 30-year mortgage or a 10-year treasury, have actually risen a little bit this year, which is somewhat surprising. But the big reason for that is that economic growth has been stronger than many expected. And that's simply put the Fed in less of a hurry to stimulate the economy by cutting rates. Then more recently, you've had talk of tax cuts and tariffs that could potentially raises some concerns around the national debt, as well as the possibility for inflation to pick up a little bit. We think all those factors could continue to keep yields somewhat elevated in the year ahead, even as the Fed continues cutting rates. That's all provided that the economy remains strong, which we do expect to be the case here. Now, I would say that doesn't take away from the attractiveness of bonds, but it does mean that we should probably expect more of that return to come from the yield component as opposed to capital appreciation, and don't expect the Fed to suddenly bring us back to the world of 0% interest rates anytime soon. But the last major theme for 2025 is just the potential, here on this slide, for volatility to pick up. It's been a very eventful year, yet stocks have really exhibited very little volatility. We haven't seen a single pullback of 10%, which is somewhat uncommon. And it actually suggests that maybe investors have gotten a little bit complacent. But when we consider the fact that there's lots of geopolitical risks out there, there's a changing political landscape, potential for some recalibration of Fed policy, we would not be surprised to see volatility pick up from current levels. But I think the important thing to keep in mind is that volatility is a very normal part of investing, very normal part of investing. And the sooner we can learn to not only accept that, but to really embrace it, I think the better off we can all become as investors, because these periods aren't fun to go through, but sell-offs can actually be a really incredible opportunity to build wealth for those who are able to buy more when things go on sale. The key, of course, is keeping that long-term focus and being disciplined and avoid making knee-jerk reactions. But as always, for our clients, we'll continue to monitor market conditions and reposition portfolios in response. So I'll leave it at that, and I'll stop there and hand it back to you, Tom.
Great. Well, thank you very much, Max. And as we, prepare our own personal financial planning, one of the important components is the markets and returns and how they impact our retirement or short-term goals. And really what we try and do from a private client advisory perspective is when we have the team together is how can we focus on your goals and what's most important to you. Of course, the stock market is up 20%. We'd like to be up 20% as well. But it really depends on your personal goals. And a lot of times, how many times have we heard, well, my neighbor, my friend, their accounts are up 15%, but mine are only up 10%. There's just a lot of factors involved. So what we try and do is craft that personal financial plan, looking from a tax perspective, investment perspective in your state, because they're all really intertwined. And that planning process, it might be 2 to 4 meetings. We're meeting with the client. We really focus in that first meeting on the qualitative, what's important to them, what are their goals, and then we kind of collect the quantitative data to build out that complex financial plan. And after a few meetings, once we fine tune that plan, it's not put on the shelf, for 5 years. It's a living, breathing document. We review that annually with our clients. And of course, if there's a change in a life event that we need to revisit or make updates, we go ahead and do that at that time. And an example, a current client that we're working with, a new client, had a first discussion, right? First, we asked, okay, well, what are your goals? And the goals were they want to retire in 3 years and have a tax efficient portfolio, consolidate their accounts, and make sure their estate plan is up to date and they're all aligned. And then, we asked, well, what's most challenging aspect of those goals? And really for them, it was, well, we think we can retire in a couple years, but can we maintain our current standard of living? And then third, we asked, well, what's most important? And to them, it was to help their adult children if they want to purchase a house. If they have families, how can they help their families with, college education or other expenses now versus waiting until they're passing as a legacy strategy. So, we gathered that information and all the quantitative reports and such. And in the second meeting, we built out that comprehensive detailed financial plan, looking at cash flow, looking at tax consequences of when to take distributions. How does taking money out today and helping their children impact their estate plan and their long-term goals as well? So we had that discussion. We made some adjustments, met again, adjustments focused on, well, maybe work part-time, maybe retire earlier, give more money to their children. So running a lot of different scenarios to provide that comfort that whatever the outcome might be, they have a lot of flexibility in their plan. So by the third meeting, we had finished that plan. We're good to go. And I think as you go back to, okay, there's always assumptions in building out these plans, inflation assumptions, which Matt kind of touched on, right? And also rates of return. And we always want to work with our clients to prepare a rate of return that meets their risk, their tolerance, the volatility to them. Of course, we'd all like to have 20% market returns, but there's a lot of risk with that to follow the market with 100% stock. So what type of return creates an allocation that helps them focus to reach their goals that we had discussed? So it's a very big component of the analysis. So in achieving their goals, we settled on a rate of return they're very comfortable with. And this kind of helps block out the noise a little bit. Of course, we want to monitor the markets and know what's taking place and be educated. We don't have to be concerned if the market's up 20, we're only up 10, but there's a reason why we're only up 10%. It's our risk, our volatility, and we still keep our goals. So that kind of goes back to the part clarity and peace of mind. We have clarity of what the goals are in terms of their investment, their planning, their tax efficiency, and how their estates can be set up, and just peace of mind knowing that that has been accomplished for now and potentially for generations in building out that plan and following that plan with their team of advisors and their family. So I turn it over to Tony to talk about the tax updates.
All right. Thank you, Tom, and good afternoon, everyone. So we're going to shift topics a bit, as Tom said, but we're going to be building on what Max was kind of discussing related to the market's impact, partially due to the election. Now we're just going to look at the election in terms of a tax policy standpoint. So basically how the election or what we think the election is going to impact individuals and small businesses as well. So if we flip over to the first slide, just reviewing the results from the election here, the Republicans hold the majority in both the Senate and the House, and obviously the executive branch as well. And I think the final House seat was called yesterday, so I think it's 220 to 215 at this point. So, one of the questions that we get a lot is kind of what can we expect in this case, particularly from the Republican Party going forward as it pertains to tax policy. So, I mentioned during our last presentation in our year-end series that, when we get asked this question, there's many people think there's a simple answer at first, right? It's a Republican control for the most part. So we're going to be looking at something like tax cuts or broad tax cuts. And, as we'll talk about, it's really never that simple. Even when we do have, in this case, one party holding a majority in Congress, as well as the executive branch, you still have a broad range of ideas within a single party, in this case, the Republican Party. So, if you think about a topic like tariffs, that was really a major theme in and during the Trump campaign and currently now, the Republican Party is very split on this issue. And I think you have some going as far as saying, under no circumstances would they support at least a blanketed tariff that impacts all imports there. And you can see here that these are not large margins by any means in either the House or the Senate. And when one party has a slim majority, you can't afford to lose more than a small number of seats when you're trying to pass party line or partisan legislation, meaning you're not reaching across the aisle to the other side to pull in some votes from them. So in this case, in which we believe is, what the Republicans are intending on doing, is each member is going to hold a significant sway over what's going to go into a tax bill, and just as importantly, what's going to stay out of a tax bill. So, and just important to keep in mind that, when we're trying to predict tax policy, in this case, 2025, and what's going to happen, it can sometimes come down to a very small group of individuals, or, in many cases, even just one individual who can basically be roadblocks to passing legislation. So we saw this, 3 years ago now, back when the Democrats had the majority in both the Senate, the House, as well as the presidency. They were trying to pass at the time a spending bill that included some significant tax items, but it was called the Build Back Better Act. And that entire legislation made it through the House, had full support of the Senate Democrats, except for one individual. And that one individual was basically stopped that legislation from being passed, and they had to go back. And what they ended up doing is doing a much more pared down version of that legislation, which became known as the Inflation Reduction Act. So again, even though Republicans have control, again, you've got a lot of different opinions and views in a single party, and it's still very hard to pass legislation through there. So if we go on to the next slide, let's talk about kind of what we do know for sure for next year. So first bullet point on there, we talked about recapping the election results, but the second one on there are the expiring tax provisions and what's been termed the upcoming tax cliff. So some background on this, there's about $4 trillion of tax increases that are coming at the end of 2025. So they're going to be effective 1/1/26. And these are scheduled tax increases. So these are scheduled to take effect, meaning that unless Congress does something, most individuals and most non-corporate businesses are going to see some significant tax increases, again, if nothing happens. Now, it's important to point out that right now, and also during this campaign, President-elect Trump has promised to address these tax issues. The Republicans in Congress have promised to address these tax issues as well. But again, regardless of what went on during the campaign, ultimately that responsibility is going to fall on Congress, and in this case, the Republicans in Congress. So they're going to be the ones that both propose and write and pass tax legislation. The president can have some say for sure, but can't move through any type of legislation unilaterally. So as we move on to the next slide, I want to talk about that $4 trillion of tax increases. What is that made up of? Now, this first slide here is related to permanent tax increases, and I'll talk about those in a second, but just some background. So if you see up at the top of that slide, the Tax Cuts and Jobs Act, or what we call the TCJA. So this was the fairly significant tax changes that took place back at the very end of 2017. And these tax changes were not bipartisan tax changes. They were partisan changes, and they were the Republicans basically unilaterally forcing through these changes to pass that bill. And they did so through a process which they're looking at doing right now, called reconciliation. And that basically allows you to get through legislation in the Senate with only a simple majority. Now, as part of the the nuances of the reconciliation process, there are certain budgetary rules that apply as well. So in order for the Republicans to get this passed back in 2017, what they basically had to do was make certain provisions in that bill temporarily. So in this case, most of the non-corporate or the individual tax changes were not made permanent. They are set to sunset or expire at the end of 2025. So when we're talking about $4 trillion of tax increases, this is what we're talking about. We're talking about tax changes that happened in 2017 that are going to revert back to their old rules effective 1/1/26. And we'll get into some more specifics about what those tax changes are. Now, on this slide here, these, the expiring tax provisions are individually focused. These are permanent provisions on here that are going to stay. The main one, I'm not going to cover all these, but the main one on here is the 21% corporate tax rate. So the old corporate tax rate was 35%. It was a gradual rate. Back in 2017, it was changed to a flat 21% corporate tax rate, and that's going to stay. That is a permanent provision that is not subject to any change unless, of course, Congress reenacts new law changing that 21% tax rate. So let's talk about what is going to change if nothing happens. If we move on to the next slide. So number one on there, again, these are the individual tax provisions. So first of all, tax rates. And you can see here all the different tax brackets that are set in the United States. Pretty much all of those are set to increase if nothing happens starting in 2026. And you can see that top tax bracket going from 37 to 39.6%. Now, in addition, over to the right there, the standard deduction is going to be cut in half. So that's the deduction you take if you don't itemize your deductions. So these amounts on here, by the way, are not exact. These are inflation adjusted deduction amounts, so those will change as well. But it is going to be cut in half, essentially. Now, on the flip side, they are going to bring back the personal exemption. So this was a deduction that you got based on the number of your dependents. So depending on what the size of your family or the number of dependents you have, this can either be a bad thing, or if your family's larger and you have more dependents, it can be a good thing because you regain back that personal exemption. Then looking down at that last bullet point, the alternative minimum tax or AMT modifications. So we didn't talk about it, but on the last slide, the corporate AMT was actually repealed permanently. It since then came back in a different form, but at the time it was repealed permanently. The individual one was temporary, and they didn't actually even repeal it. What they did is they basically increased the exemption and the phase out amounts to where most people who were traditionally subject to the alternative minimum tax were no longer subject to it after 2017. Again, this is going to revert back to those old rates and rules, in which case not only are you going to have more people or people paying higher tax rates because of those bracket increases up above, but you're also going to have more people subject to the alternative minimum tax because these old exemption and phase out rules are going to come back into play. Okay, on to the next slide. Some other things that will change and not for the better. The child tax credit is set to be essentially be cut in half here, and probably just as significant as that is the phase out amount, which is the amount of income you have to be below. So if you're over $400,000, your credit's going to be starts to phase out. That phase out is going to decrease down to the old uninflation adjusted amount of $110,000. So not only is the child tax credit going to be significantly smaller, you're going to have a lot less people that are able to claim it because you have to be under $110,000 of income for a married filing joint tax return there. Charitable contributions, there's a limitation on how much you can deduct in a certain year for cash contributions. This is set to decrease down to the old law, which was 50%. And then a very significant one, the estate and gift tax exemption is going to reset to the pre-2017 amounts. And Kathy's going to talk about that in some more detail, but definitely one that's getting a lot of attention right now and will be getting a lot of attention the further we get into next year if none of this stuff is extended. So we talked about, if we can go on to the next slide, we talked about the negatives of what's going to happen, but there's also some positives that will happen if all these provisions are allowed to expire. And this slide covers what we would call kind of the positive side of this. So the first bullet point on there, miscellaneous itemized deductions. So this was the ability to deduct things like your investment fees, your unreimbursed employee expenses, your tax prep fees. So those were actually, that deduction was suspended in 2017. So you were no longer able to take any of these deductions on your 1040 or on your individual return if you itemized deductions. Now, after, again, if nothing changes, these deductions will be allowed after beginning in 2026 here. The second one on there, the state and local deduction, or the SALT deduction limitation. This is probably the most significant one in terms of a benefit to taxpayers. So the deduction right now, so if you think about your property taxes, your state income taxes, if you pay state income taxes, you add those two numbers up, those are the main ones. And basically anything above $10,000, you can no longer deduct on your 1040. Now, there's certain rules around that if they're being generated through businesses, but basically that's the rule, is you can't deduct over $10,000. Now, starting again, if nothing happens, starting in 2026, this deduction or limitation, this $10,000 cap, is going to go away. It's going to revert back to the old rule. In the old rule, there wasn't a cap on itemized deductions, at least not a hard cap like this. There was just an overall itemized deduction limitations that you had to comply with. So that would definitely be a benefit for a lot of our clients, to remove this SALT deduction cap and go back to just being able to deduct the full amount to a certain extent. And then the last bullet point on there, mortgage interest deduction, that the amount of interest that you can deduct on your 1040 was capped at basically an acquisition indebtedness of $750,000. So if your home cost or your mortgage was over $750,000, you could not deduct the interest on that portion of it. And also, in addition, you cannot deduct any interest on home equity indebtedness. So again, that was a new law starting in 2017. If nothing happens in the next year, we're going to go back to the old rule. And the old rule was $1 million of acquisition indebtedness, so $1 million of a mortgage. And then also up to, you can deduct the interest on up to $100,000 of a home equity loan as well. Okay, on to the next slide. We're going to end this section with a little bit on some business-related provisions they're business-related, but they impact you at the individual level or the 1040 level. So the first one on there, the excess business loss limitation. So what this rule basically did was limit the amount of business losses you could deduct against your other buckets of income. So if you had a loss through your business of, let's say $1 million, and you had W-2 wages on your 1040, you had portfolio income, your interest and your dividends, you were limited in how much, and you are limited in how much you can use that business loss to deduct against those other buckets of income. And that's not going anywhere, at least for the next couple of years. That was extended as part of a different legislation into 2028. So that is going to stay regardless of what happens at the end of the year. The qualified business income deduction for pass-through entities. So for our partnerships and our S-corps. So, this is a very significant item for our business owners that operate as a flow-through entity, that operate as a partnership or an S corporation. So under the current law, you can deduct up to 20. So on your 1040, you can deduct up to 20% of your business income on your tax return. If nothing happens by the end of next year, there's going to be no deduction on your business income. So if you think back to our tax brackets and our tax rates that we discussed earlier on, if you were at let's say the top tax bracket of 37%, if you got a 20% deduction, that effectively dropped your tax that you pay on your business income, all the way down to slightly under 30%. So, if this is not extended, that bullet point on there, it says if it's not extended, S corporations, partnerships are going to see significantly higher tax rates on their business income. Now, that last bullet point, increased interest in a C corporate structure, so in a traditional corporate structure. And what that bullet point is basically saying, if we talked about earlier, C corporations pay a 21% flat tax. If we lose this deduction for our S corporations and our partnerships, those will be essentially taxed at either 37 or 39.6%, whatever that top tax bracket, if you're in that top tax bracket. So we compare, let's say 40% to 21%. Well, that's almost a 20% difference in the tax rates that you would pay on your business income if you operated as a corporation versus operating as a pass-through entity. Now, with that being said, corporations do pay a double layer of tax when they pay out a dividend to their shareholders. But at the very least, if I'm a business owner and I can defer, maybe not permanently, but at least defer about a 19 to 20% tax difference and invest that back into my company, I'm going to be thinking very hard come the end of next year, if nothing changes, about whether or not I should be operating in my current flow through structure versus a C corporate structure going forward. So a pretty significant item here, again, if this is allowed to lapse, for our flow through and our S corp and partnership businesses. Okay, so if we move on to the next slide, just want to cover a little bit on some of the proposals that came out, specifically President-elect Trump's proposals that came out during the campaign, and they've since been altered slightly since then. But the first item on here, so basically the cornerstone of what would be both the Republicans as well as President-elect Trump's tax policy is all those tax cuts that are going to expire that we just covered, right? The lower rates, the pass-through deduction. They want to, at least at the very least, they want to make all of those tax cuts permanent. If they can't make them permanent because of certain budgetary rules, they want to extend them. So it would be another temporary tax provision there. So again, there wouldn't be new cuts necessarily. We would just maintain our current tax rates and tax structure that we have going in this year and then going into the next year as well. Also mentioned during the campaign on that second one there, lowering the corporate tax rate. Not much to say about this one, but the one interesting piece that was brought up was potentially having a lower tax rate for companies that manufacture or produce goods within the United States. Now, how we actually get there, I'm not sure, but that has been brought up several times, both by the Republicans and President-elect Trump during that campaign. Last one on here, pretty significant for our business owners. This is a package of business tax changes that are slowly phasing out or expired that they want to bring back. Number one, 100% bonus depreciation, having that ability to immediately write off your fixed asset purchases, at least for tax purposes. So that's currently fully phasing down. They want to bring that back. R&D expensing, this is a big one. This changed 2 years ago. Being able to, again, go back to deducting your R&D cost versus having to capitalize those costs and amortizing them over a 5-year or 15-year window. Pretty significant one here, especially for people that are investing significantly in any type of research and development. And that last one on there, EBITDA-based interest limitations. This would basically go, allow companies to once again deduct, companies that have a heavy debt load, deduct their interest payments versus having to defer those deductions into future years. Okay, so those are some business-focused ones. Here's some of the individual proposals that came out. Now, not as much detail on these, but the first one on there, expanding that child tax credit to $5,000. So not only would it not get cut in half to $1,000, under this proposal, obviously it would go up significantly. In addition, there was talk about some type of family caregiver tax credit. Again, not much detail was ever released on that. The third one on there, a very interesting one, eliminating taxes on certain types of income. And these were brought out through various points in the campaign, probably depending on who the audience was. But I would say on these, these were, again, presidential proposals, or sorry, campaign proposals. I don't think there's much support for any of these within the Republican Party as a whole. So I don't anticipate seeing any of these becoming law. Creating an itemized deduction for auto loan interest. That was brought up during the campaign. And the last one on there was something that wasn't brought up, which is basically that there's no proposals to either increase or decrease the rates that you pay on capital gains or your dividends, so your portfolio income gains. I have not seen anything come out recently that talks about increasing it or decreasing it, so either direction. So I do expect that portfolio income tax rate to stay somewhat constant, at least over the next 2 years. Okay, so how we talked about all these tax cuts. So, how are these cuts going to be paid for, or at least how are they going to be paid for in part? And there's 3 items on this slide. Really, 2 are the major ones. And the first one on there is repealing the Inflation Reduction Act, so the IRA. And I mentioned this briefly at the beginning of the presentation, but this is the law that was passed several years back that basically created all of the, I shouldn't say created, they created some and they really expanded or enhanced certain other various types of green energy tax credits. So if you think about the credits you can get for purchasing an electric vehicle, the credits you can get for as a business or as an individual for putting solar panels, charging stations in certain areas, these are the credits that were part of the Inflation Reduction Act. And the Inflation Reduction Act had no support from any Senate Republicans. So if we talked about the Tax Cuts and Jobs Act back in 2017 being a Republican partisan effort, the Inflation Reduction Act in 2022 was a Democrat partisan effort, meaning it was moved through the Senate using the same reconciliation process that the Republicans used back in 2017. So both parties are more than willing to use this Senate go-around to pass legislation. And what that also means is that the Republicans, and many of them, don't feel any loyalty to this bill that they had no part of. So, there are certainly some jurisdictions, some Republican jurisdictions that have benefited significantly from this, but this is definitely going to be a target when the Republicans are looking for revenue raisers next year when they're trying to put together that tax bill. The next one on there, imposing an excise tax on large private university endowments. It's been talked about for a while. I've never seen really too much detail on that. And then the third one on here, the major one, the one that's getting probably the most attention, not really a income tax proposal that we would traditionally think of, but that is imposing a universal baseline tariff on all imports somewhere in the range of 10 to 20%. And so basically anything that comes in the US would be subject to some type of baseline tariff. And then you see in addition there, with some asterisks, a 60% tariff on all imports from China. More recently, a 25% tariff on imports from Canada and Mexico. Now, the Canada and Mexico ones are basically being used, I would say, as leverage to what President-elect Trump's campaign has basically said is a way to help kind of stem the tide of illegal immigration, drugs coming across the border. So they're basically trying to use the threats of tariffs as leverage in order to do that, to accomplish some other type of agenda here. Last 2 bullet points: the impact on businesses, price increases. I don't think anyone would say that this would not, if these were actually passed, specifically if a universal baseline tariff was passed, this would be a significant shift away from what's been the U.S. policy, at least for a while. In addition to that, I think the big question that most people are asking, whether or not you're a business owner or you're an individual, is, what type of impact, what type of price pressure is going to be put on goods if something like this were allowed to pass, if tariffs were allowed to be enacted, right? Who's going to be the winners and who's going to be the losers from a tariff policy that's a blanketed tariff policy? So some pretty significant questions here when it comes to tariffs. Again, you've got a very divided view on tariffs on both sides of the aisle, but also specifically in this case within the Republican Party as well. Okay, so we're going to wrap things up with this slide here, and we're actually just going to talk a little bit more, less about what's on this slide, but a little bit more about what we think in terms of an estimated timeline for a tax bill. So if we go back to the beginning of 2017, at that point in time, President Trump was inaugurated the end of January, and the actual tax bill that was passed was not passed until December, sometime close to Christmas in 2017. It was like December 21st or something in 2017. So again, even with Republican control in both the Senate and the House, and obviously going into or in the executive branch as well, it still took a full or almost a full year to pass something. Now, I would say the one major difference is that back in 2017, the negotiations were on some more fundamental tax changes that were being proposed. This would basically be keeping the same tax laws that we have. So it's not as big of a change that they're trying to enact, at least if that's what they're going to limit the scope to. So we're not likely to see anything as significant as what happened in 2017. And, what I've been reading, and these are just obviously, best case scenarios if you're in the Republican Party, but they are talking about trying to get something done possibly in February. That would be a very quick time frame. And they've also talked about splitting up the bills, doing some type of smaller bill at first, and then doing a larger bill towards the end of the year, because they do have two chances at passing bills in 2025 using the reconciliation process. Just based off what they're saying, the first 100 days, when it comes to the first 100 days of a presidency, that's going to be their goal, right? You bring in a lot of momentum when with all these election victories. You want to build on that if you're in the Republican Party. And generally, if something doesn't happen in that first 100 days, it really tends to get dragged out over the rest of the year, as we saw a perfect example with that 2017 tax bill. So just wrap it up with, we'll basically have to wait and see. But I think it goes without saying, as we get further and further into next year and we don't have a tax bill passed, or especially if we don't have one proposed at that point, there's more certainty that's going to exist related to that $4 trillion in tax increases that are kind of hanging over everyone's heads right now. All right, with that, I am going to turn it over to Kathy to wrap up with estate planning considerations. Kathy?
Thanks, Tony. So good afternoon, everyone. Thanks for being here today. My name is Kathy Shoemaker. I'm excited to talk to you about a topic that can at times be overlooked, but is incredibly important for ensuring the future security and peace of mind for you and your family and your loved ones. We're going to talk about life and estate planning. So, moving on to the next slide, what is estate planning? What exactly does it mean? Estate planning is a crucial process that involves organizing and preparing for the management and distribution of your assets during life, if you become incapacitated or after death. Generally includes creating some essential legal documents such as wills, trusts, powers of attorney. These documents ensure that your wishes are followed. It helps minimize taxes, provides peace of mind for you and your loved ones. Each one of these documents serve a little different purpose. I'm going to highlight each one briefly here. So a will is a document that you draft. You identify in that document how you want your assets to be distributed at your death. It is a court-supervised process. It is also the only document where you can name a guardian for your children. A trust, similar to a will, is a document where you identify how you want your assets to pass when you pass away. However, it is not court supervised. You do not need to go through a formal court process. And then we have powers of attorney. We have financial powers of attorney, healthcare powers of attorney, those documents that can assist with financial and medical needs during your life if they come up. Estate planning isn't just for the wealthy or the elderly. It's a crucial step for anyone who wants to make sure their wishes are honored and their assets are protected. I want to, share I'll often be talking with clients, clients maybe in their late 50s, early 60s. They started a business 15 years ago. Business is operating smooth, right, on a growth trajectory still. Maybe they're starting to think a little bit about retirement. What are they going to do with the succession of that business? Things are happening in their lives now that are different. Maybe children are getting married, maybe grandchildren are getting born. And I'll ask, so what's your estate plan look like? Some of them shock me and say they don't have one in place yet. Others say, oh yeah, we drafted that 14 years ago. It's sitting in our drawer. Things change over time. That's why I put the life in the planning piece of it. Estate planning can oftentimes make people a little hesitant, thinking, oh, we've got so much time, or they're just don't like the concept or the thought of passing. Not many of us do, or we don't want to deal with, the transfer of our assets. We want to keep control. But these things are important to be looked at regularly. I recommend generally every 3 to 5 years, you sit down with your advisor, just take a look at your plan. Does it still meet your needs? Does it still meet your goals? What do we need to add? What might we need to eliminate? This is the time to be making those types of changes. So a lot of predicting going on in our conversations, right, on tax law changes, and estate and gift tax exemption amounts are among those that are being talked about frequently right now, actually for the last several years. So when I started in this practice probably 25 years ago now, the exemption was $600,000 and the tax rate was 50%. So we've gone through several significant increases in the exemption. And if you could move to the next slide, I have one here that I just wanted to talk about. This was back in 2011. Estate and gift tax laws provided some substantial increases to our exemption amount. It went up to $5 million. But here we had a temporary and set to expire increased exemption that was going to expire at the end of 2012 unless further legislative action was taken. So take a look for a minute. From 2011 to 2012, we had a 42.93% increase in the number of gift tax returns filed, and we had a 219.48% increase in the amount of wealth transferred. Just take a look at that number, 120 with lots of zeros, up to 385. There were a significant amount of transfers to trusts versus individuals. And let's fast forward now to 2025. So if you could go to the next slide, please. We'll talk here a minute about just some terminology, make sure everybody understands what I'm chatting about, and then where we sit currently. So we all have a basic exclusion amount. This is the amount that we can transfer during life or at death to anyone without having to pay any type of transfer tax. Currently for 2024, that's 13.61 million. We had an inflationary adjustment, in 2025, up to 13.99. In addition to that, we have what's called an annual exclusion. This amount is something that we can do every year to anybody and not use any of our lifetime basic exclusion amount I just chatted about above. So I could write a check currently to everybody on this call for $18,000 and not use any of my exemption, and that would incredibly reduce my current estate. Next year, that's at $19,000. This annual exclusion isn't set to do anything but continue on its trajectory with inflationary adjustments every year. This won't be halved like the exclusion amount above. We have freebies. These freebies are I can write checks for qualified education expenses or medical expenses directly to the providers. So I could write a check to the University of Michigan for my grandson Lewis for his tuition. I'm not going to use my annual exclusion. I'm not going to use my basic exclusion. I can write a check for the orthodontia care of my other grandson directly to the orthodontist for $10,000 and not use any of my annual exclusion or basic exclusion. Now, the basic exclusion amount is set to reduce to half at the end of 2025 or as of 1/1/26, as Tony mentioned earlier. So after the end of next year, my transferability is going to go from almost 14 million to 7. And that's a significant impact on planning. So here we sit again, looking at the possible sunset of a significant exemption. And as Tony mentioned earlier as well, it's anticipated that these higher exemptions will remain in place for at least the next 4 years. However, that's not a guarantee. The estate tax exemption doesn't impact a lot of people. It does generate, I want to say, I thought it was $198 billion over the next 40 years. But a lot of planning has been taking place over the last few years. One of the parts that I enjoy the most of my job is estate planning is an art, it's not a science, and it impacts every family differently. Some are more concerned about taxes, some are more concerned about creditor protection, some are more concerned about ensuring a child doesn't have complete access to funds until certain ages. So there's a wide range of reasons why estate or life planning is important. But from a tax perspective, being able to use that exemption now, that higher amount, is very important for those that sit with large or complex estates. Moderate estates, if you could define a moderate estate, I would probably put it at between 3 million and 10 million for a single person. So for a married couple, that would be 6 to 20, and a large estate, probably 20 million, 10 million for a single, 20 million for a couple. Thinking about complex assets in large estates, those, business interests that need to be transferred, anticipated changes in financial position. It's not uncommon now to see a 60, 70-year-old individual that still have parents alive where they could be looking to inherit a significant amount of wealth. Or maybe you were lucky enough to get one of those winning lottery tickets, so you've got a windfall that you need to consider. But as estate planners, we have a lot of tools in our toolbox to help you develop a strategic plan tailored to your current wealth, your current family. We want to help you reduce estate taxes, minimize income tax exposure, while also ensuring that cash flow needs are met throughout your lifetime. Nobody wants to give away $12 million and then not have cash flow for themselves to live the way they're accustomed to living just to save some estate tax. And we can help plan around that to ensure that doesn't happen. So we have, like I mentioned, we have a significant amount of tools we can use to help meet most needs of families and desires of families. We want to make sure that we're planning and not predicting. That's why I mentioned the prediction word before. A lot of us have been working with our clients to become comfortable with the concept of transferring assets, maybe transferring control of a business. A lot of our business clients, the largest asset that makes up their gross estate is their business interest. Giving up control of that can be very difficult. So we want to be planning and thinking about it. We've gotten, we're marching up against a fence, I guess, and we want to walk through the gate to the other side and actually implement a plan. And it's, as Tom was mentioning earlier with the client as well, it's a lot of back and forth. Let's sit down. Let's look at what we have in front of us today. Let's talk through a couple of items, model something for you. We often come back. Here's what we've come up with. What do you think? What are we missing? What haven't we thought of, right? We'll go back to the drawing board oftentimes, come up with some additional scenarios, thoughts, or processes. It's a process that can take a lot of time, months, 6, 12 months sometimes, or longer, to get clients comfortable with strategies, and meeting and then implementing those strategies. So when we're talking about tax law changes, as Tony mentioned before as well, who knows when we will know exactly what will be implemented? It could be February, it could be June, or it could be December 25th, 26th, very end of December. Hopefully it's not on Christmas Day. But the planning that is required takes time to implement. Trust documents need to be drafted. Oftentimes valuations need to be obtained or appraisals. Professionals need to meet with you to identify your needs and strategize to implement a good plan. If we continue to wait and see, maybe take our foot off the gas pedal or kind of get back to sitting on the fence versus walking through the gate, we could lose some opportunities to implement a good plan if professionals are unable to meet the needs that are needed, waiting till the third quarter or fourth quarter of next year. So I guess, to keep in mind and to have as top of mind and key takeaway for you here is stay committed to planning rather than predicting, as trying to foresee new tax rules is futile. We all have our ideas, we all have our crystal balls, but ultimately we won't know until we know. And it's good to just keep marching forward with planning and talking with your advisors, and we're here to help as part of your team.
Great, Kathy. Thank you very much. I love the phrase planning, not predicting. Probably in our personal life as well, I think I might take advantage of that. So as we started today's webinar, we talked about really the uniqueness of private client advisory and our service model of providing a number of services that we talked about today: advisory and tax, wealth management, estate gift and trust, family office, as well as Rehmann Trust. As you can see by our panelists here, we covered all those areas, and it's all about planning, identifying our goals, what's important to our clients, and really being proactive, having those discussions very early, having the team think about things that you might not think about in the short to long term. We certainly want to thank our panelists today. Max and Kathy and Tony did a phenomenal job. You can see they are tremendous with clients. And we want to wish everyone a great holiday, a very, very happy new year. And for those Detroit Lions fans, a 2025 Super Bowl. Thank you very much.